Sam and I wanted to kind of go over this topic because it's kind of been a theme for a lot of clients, like, oh, should we buy now? Or is like, the interest rates are so high. When do I buy? Right. So it's kind of a combination of lots of those conversations we've had with potential clients and clients. And then I'm going to touch a little bit on the seller expectation through the latter part of the slides. So it'll give you an idea of what to expect. But first things first, Sam, would you like to introduce yourself?
Sure. Hi, I'm Samantha Shue with Origin Point Mortgage. I'm in the top 5% of loan originators across the country. I've been doing loans for over 15 years. I really love the puzzle of what I do. I also love my 2 kids, one who's at sleepaway camp right now, which is really fun. And I have my doggy by my side. And my vision for the world is positivity and gratitude. Shannon, do you want to go next?
Awesome. Hi, my name is Shannon Shue. I'm a real estate agent and an investor. I'm in the top 1.5% of agents nationwide as an individual agent. So it's me and a small team of admin and people that help. As an investor, I own 17 units and a self-storage facility. So I continue to want to teach people how to invest in real estate as a way to retire early and be able to have passive income through real estate. I love Vietnamese spring rolls, and my vision for the world is connection and vulnerability. So what's going on in the market today? It's sort of like the question I hear as a realtor a lot, and that is like, how's the market, right? And so I always say now in 2023, I'm like, there's no one answer for that. So I always say, so it depends on who you are, if you are a buyer or a seller in today's market. So I'm going to go over a couple key things that have been sort of hot topics that really help determine what happens in the market. So inflation is a big thing. We're increasing the interest rates to quell inflation and bring inflation down. But that also means the cost of money to borrow is high. The second thing is inventory. As much as the interest rates are as high as they are now compared to 1 year ago from today, the inventory is less than it was last year. So we have less to buy, meaning all buyers have less to buy, and sellers are not selling unless they have to, or unless it really otherwise would prevent them from doing what they need to do next in life. For you, Rosalie, potentially retiring. For some of my clients, it's a probate or a trust sale, or they simply are just and then there's also the other situations like debt and divorce, right? So there are no people testing the market as sellers, right? Buyer expectations. So I want to go over buyer expectations because the expectations have shifted quite dramatically just in the last 6 to 8 months from the average buyer of last year versus the average buyer today. And I think it varies, I think, from market to market, but for the most part, and you might agree with some of what I have to say in that third section, Susan, but buyers' expectations are very high now. So let's just kind of talk a little bit about inflation. So this is just inflation over the last 3 years, essentially about a year before the pandemic hit. And you can tell that that really before the pandemic, all the way up until January, inflation was very, very healthy at under 2%. And that is considered to be sort of like a real key area to stay under, right? And then from around early January 2021 to now, as the interest rates went down, the inflation went up. So when you see inflation going up like this, it is cause for concern for the country because it devalues our money, but it's been devaluing currencies across the world. So we're not any different. So the cost of things just go up when we have such low interest rates. It's not a 1-for-1, but it is a very close, it's one of the closest indicators we have. But now today, inflation numbers came out. This is actually as of May, so we don't even have last week, which I know Sam is going to talk a little bit about that. But the inflation numbers are looking like the interest rate is affecting them more dramatically, and it's what the Feds wanted to see. The Federal Reserve wanted to see that. So, okay, next. Overall home sales in the United States. So I just used a nationally in 2021, we had 6.1 million. So 6,100,000 transactions throughout the United States. That's every single transaction. Last year, we were at 5 million. So that's 1.1 million transactions that went away. As interest rates went up, sellers were saying, never mind, I don't want to sell anymore if I can't get that number, or if I can't get the buyers to buy at the price I want, right? So it is projected that we are still on a downward trajectory, that 2023 would have even less. And that tells us that there's less inventory, that sellers are hanging on unless they need to sell, or it really helps them get to what they need to do next in life. So this is just a home sales by month versus like that one was by year. This is nationally, and you can see that last year in May, we had what is considered 5.4 months of inventory. Now we have 4.3 months of inventory. And how that works out is 6 months of inventory is considered a balanced market, meaning there's enough homes for sale and buyers to buy them at 6 months of inventory. So if you had 100 homes for sale and there were 100 buyers for them, it's considered a balanced market. Everyone can be met by how much is in the market, and that's considered 6 months, right? When it's less than 6 months, it's a seller's market, which means the sellers know there's less to buy and there are more buyers out there to buy it. So last year we had about anywhere in the 5-month range of inventory, and now we're at 4. So there's less to buy. Buyers still want to buy, and there isn't enough. So I love this report, but it's so hard to see. So I'm going to read parts of the sections that are the most telling, especially like for Susan, who's in the car. This is in LA County. And I use LA County, but LA County, we just have higher price points, kind of like the Bay Area and parts of Honolulu. Statewide, average median price point is $849, and things are saying on the market 27 days. In the Los Angeles County area, the median home price is $1.588 million, and it stays on market for about 35 days. So that's a pretty high median home price point. And then you can see when you break down May, we didn't have a lot to sell. I mean, we do see no growth. We are down from the previous month, 14.8%. Year to year decline in the amount of homes that sold, which means there's just less to buy. And then I just want to point out, and this might be in your market too, but anywhere where there was growth, where there was more sales and it sold for more than last year, they are all of the very good school districts and the highest price points in Los Angeles. School districts often lend itself to higher price points because people will pay more so their kids can go to a A-rated school. So all of these neighborhoods in Los Angeles.
Same in Jersey.
Yeah.
Same in Jersey.
Yes. And same across the country. Everyone will pay more for a better school district because in exchange for private school, annually, you are paying your property taxes, and your property taxes help that school district. But all of these properties that sold and went up in price point, again, are the best A-rated school districts in LA County. And then you can see there's declines, like there's just less inventory in other neighborhoods, and they didn't sell for as much. So what does that tell me? It tells me that people in higher price points aren't affected, right? Inflation doesn't hit you as hard if you're looking for a a $4 million home in Santa Monica so your kids can go to Santa Monica School District, you had to compete and there wasn't enough $4 million homes to buy. So you ended up paying quite a bit more, maybe upwards of multiple offers and upwards of like an increase over last year. I mean, here it doesn't show you what it is, right? Anywhere from 10 to 15% more than it was valued at last year at this very time, right? So keep that in mind. Oops, sorry. Trigger happy. So yeah, so let me just kind of go over expectations I'm noticing in the market. Buyers want more for less generally, and more for less is, it looks like things like, well, I'm already paying a high interest rate, so I want a rate buy down. I want a larger credit for my repairs. I want closing costs. And in Los Angeles in particular, a lot of sellers are saying no, no, and no. So no to the rate buy down, no to the larger credit repair. I'll give you some, but not large. Like, here's $6,000, not $16,000 and not $26,000. And closing costs. Anytime I see an offer with a buyer asking for closing costs, immediately I'm like, well, I think you might go to the bottom of the pile, because that means you don't have enough money to close this loan. And if I have multiple offers, and I do have multiple offers on every listing, I need a buyer that has enough money to pay for their own closing costs, right? I don't want the seller to credit that and then have to be beholden to all the other things that may come along with it, like, oh, appraisal shortfall, or, oh, the lender is taking an additional 3 weeks to close you. We don't need any of that as part of choosing a buyer. A lot of buyers are expecting things like they want to see the permits and they want extra disclosures on condition. Well, why don't they know when the roof was last redone? They said it was 7 or more years ago. They're like, they don't know if it's 8 years or 10 years. Like, can't they just tell me the number? And sometimes the seller doesn't know, right? And buyers feel like that is a level of distrust. Like, oh, you don't even know when you do your own roof. That's weird, So they distrust the seller if they don't have more details. The last thing is, a lot of buyers now are not interested in putting in sweat equity. That just doesn't feel like their best use of capital or their way they want to do things. Oh, if you just, spruce up this kitchen and this bathroom, you'll see it'll be worth just as much as the one that down the street that sold for 20% more. And they're like, well, we're putting all our money into buying it. We don't have any extra money to do the kitchen and bathrooms. So that doesn't feel like a carrot, like a bonus. It feels like, well, one day we'll do the kitchen and the bathrooms. We're just concerned, is this all permitted? And when was the roof done? So buyers are getting, they're not feeling like that's such a big bonus for them. Like, it's nice, but it doesn't feel like tangible today. And then next are seller expectations. Sellers are recognizing they're taking less, and the ones that come to market say, okay, we're taking a little less than last year. We still want to sell it. We have a lot of equity, and we're happy that we're going to sell it for far more than we paid for it. It's been a great investment, or it's been a great home. So go ahead. We'll put it on market and we'll take a little bit less based on the comparable sales in the neighborhood. Sellers also are expecting, they don't want to give so much in concession. They feel like concession is they're selling their home for less than last year. And there's a little bit of a disconnect in that. I think that they do have to give concessions, and I think they are. They're not saying no money, but buyers are like, I want you to do more. And sellers like, I will do some, not all. And then multiple.
Like my kids. I want everything. You'll have a little, but not everything.
You can have some, but you can have all. Yes.
Right.
Good agents are able to kind of keep the deal together, but that's some and all. That's where all the negotiating is happening. If it isn't happening when you get the multiple offers and negotiating people to make sure they're the best offer you're taking into escrow and they will close, then the second big yardstick for measuring a good agent, in my experience, is Sum and all. Are you having too much of the all conversation and not enough of the sum conversation? And sellers are expecting multiple offers. They see that there's less inventory. They know that there's not a whole lot like that home on the market. And if priced well, they should be able to get multiples. If they are priced too high, they just sit.
2008 recession was a very different recession from the one that we're in or we're about to be in. Who knows if we're in it or not. People are so afraid of it because they remember home prices fell out. And it was all because of the mortgage industry. And we were selling, I was in the mortgage business in 2001, and we were paid more if we were going to be selling loans that were negative amortization loans where buyers were paying less than the actual payment due, sort of on your credit card, where you could pay a minimum payment. And then they started to, they owed more than when the house prices dropped, they owed more than the house prices were, and they ended up foreclosing. I don't see this happening again in the future because there's so many more rules in place. We are completely a way more regulated industry than we ever were. And so there were a lot of those adjustable loans, a lot of have a bankruptcy yesterday, we can do a loan today. We had all of those. We don't have those anymore. There are some really cool alternative programs now, but they are really pretty well vetted because buyers usually have a lot more in reserves or something like that. Also, because we had such high appreciation, Shannon, I heard there was like 40% appreciation in 2020. I don't know if that is a legit piece of data that I heard, but it seems that way. And therefore, so many people have so much equity in their homes. And therefore, they can afford the homes because the interest rates that they have are probably in the 2s or 3%. And they have so much equity. So they're not going to leave their house. They're sort of like rate prisoners, which is what's causing the whole reason why we have no inventory. If they're going to move, they're not going to want to pay a 7.5% interest rate. Let's go to the next slide. There's a really great book. If you haven't read it before, I would highly suggest it. It's called The Housing Boom and Bust. And it really addressed all of what happened really in 2008 and with the subprime loans, which is, fog a mirror, get a loan. And it was also like the government was actually kind of pushing lenders to create home ownership and to create these very easy, these fast and easy loans we used to have. And so that's what caused the recession. We are not in that. That is not the reason why we're in the recession we are about to be in or in already. Also, a very big piece of data is the supply of homes was twice as much as the demand at the beginning of 2006, where it is like the amount of demand we have is so high. And even though interest rates are so high and demand is so high, but there's still so much pent up demand that is still on the sidelines waiting for rates to come down. So if you want to go to the next one, please. Thank you. So are we in a recession? Are we not? There's a lot of signals showing that we are, but I don't believe that we actually are quite yet. The first one is high inflation. We already know we have high inflation. A year ago, inflation was at 9%, and now we're all the way down to about 3 or 4%, which made that core price index number come way down, which made interest rates come down a little bit last week. We had a bit of a improvement in rates, and now they're up again. So that's one big sign of recession. The second sign is 2 quarters of negative GDP growth. We have not had negative 2 consistent or consecutive quarters of negative GDP, but we have had negative GDI, growth domestic income. So people are making less money for new jobs that they're taking on. So the Fed is thinking about this, but it's not truly GDP. So it's not necessarily saying, yes, we are in a recession just yet. We're also waiting for a big uptick in unemployment. So we've heard about a lot of layoffs, but it hasn't just has it happened already, or is it not, or is it about to? So that's why I put that question mark. Are we waiting for something else? But above all, 30% of homes across the country have multiple offers. And Shannon's saying 80 offers. I'm sure you in New Jersey, you're seeing so many offers on every house. And I just keep writing pre-approval letters, and these poor buyers are just so sad because they're not getting their offers accepted. The market is super duper hot. And it's a frenzy again to try to find a house, and they don't care where rates are at all. They're just like, let me get something. Go ahead, please, to the next slide. just to give you an idea of what's happening around the world. Bank of Canada raised their rates last month in June by a quarter. Bank of England raised their rates by a half. Turkey raised their rates. I had to read this twice. They had to raise their rate by 6.5 bips in June, not up to 6.5, but by 6.5 percentage points, like insane interest rates in Turkey because of their insane inflation. The EU in June stated they were officially in a recession. And since the US Fed has been doing 11 rate hikes, 2 more probably scheduled for this year, still because of inflation. So we're still going to see higher interest rates and low inventory, and this is just the norm. Let's go to the next one, please. But the rates, this is the norm, right? Rates right now are ranging anywhere. FHA and VA loans have still really good rates. Those are still in the low. I even saw a 5% last week and I almost fell out of my chair. I was so happy to see 5.85 on a VA loan available at no point. But VA and FHA are somewhere around high 5s, low 6s, up to maybe 6.5. And then the standard conventional or non-qualified mortgages like bank statement loans, investor loans, all of those can range from 6.5 all the way to almost 10%. But if you look at rates, and if you can tell anyone, any of your friends today, this is the norm, right? If our average interest rate is around 7 today, 7.76 is the average interest rate over the last 30 years. And for those of you who purchased a home in the 80s, you know, when I was born in 1979, interest rates were at 18%. When I got into the mortgage business in 2001, interest rates were about 7.5, and no one said a word. Everyone was like, okay, no problem, move on, right? And then we've been so jaded because rates dropped to the 2s and 3s in 2020 and 2021. And now seeing that rates are so much higher, it's scary for a lot of people. And so my next slide, I talk about this all the time. You might not have heard it yet. And I know a lot of people haven't. So I always like to say it. Marry the house, date the rate, right? After every recession, so you may not be able to see this slide, but after every recession we've had for the last 50 years, you'll see them all there in yellow. And those yellow bars, right on the yellow bar, right before it began, the interest rates start, you know, right at one point. And then if you look just after the yellow bar, the interest rate is a little bit lower than it was before the recession began. So we had a short recession in 2020. But prior to that in 2010, you'll see interest rates started a little bit higher, and then after the yellow bar, ended up lower. And then what does this do to home prices, right? Case-Shiller has stated that after every recession, home prices go up. So what you want to do is, you know, yes, you want to be the realtor or the friend that says, oh yeah, it's a good time. You definitely should wait. You should wait. Everybody, yeah, you should wait because rates will come down. But if you wait, that home price that you wanted to buy today is going to be worth more when rates go down. If you'd like to go to the next slide, that will help me out. So there's this huge tidal wave of demand, right? People who may need to buy or sell right now are waiting because they're waiting for rates to come down. There are others who are already buying and selling because rates, despite the rates. But the fact is that home prices are going to be going up, even though it seems as though, like, gosh, there's got to be a place at which the home prices just come down or flatten, but it's just because we have no inventory and we have so much demand. It seems to me that if you can feel comfortable with the payment where the rate is now, we have options like 2-1 buy downs where the rates can come down by 2% for a year and 1% for the next year. And those are all great if the seller is willing to pay for it or if you finance it into your purchase price. There's some ways to get creative to make the payment a little bit more comfortable. But at the end of the day, I'm finding that people who are a little bit more wealthy, who have a little bit of extra income, are the ones who are able to afford a home right now and hopefully be able to get into a home today where in a year from now, they'll just refinance when the recession is over and hopefully be able to get a much better rate and lock it in for 30 years.
All right, you guys. Well, I guess I will... We can close it out here, and certainly happy to follow up with you all. Neil, it's good to see you. I know we didn't have a chance to talk much. You kind of got us to towards the end of the Q&A, but we'll circle back and say hi. And in the meantime, I hope you guys all have a fantastic rest of the week.